The stock markets can give little heart attacks if your hard-earned money is not invested wisely. With each dip, our heart sinks, and with each rise, our blood level increases, isn't it? We're here to give you the names of the top 5 companies where you should definitely invest. At number 5, we have Visa, the world's largest publicly traded financial services company. It worked with over 100 million merchants all over the earth and was behind more than 13 trillion transactions in 2021. It made transitions comfortable by switching from cash to digital medium. Interestingly, it gets benefited from the gradual inflation. This is because its standard digital money model takes a small cut of all digital transactions, which is why it's one of the safest companies to invest in. Though it's no longer the fastest growing digital payment provider, its stability and persistent return to the cash market make it an attractive investment opportunity. It has a record of shocking the world by outperforming market expectations. Like it suffered a severe blow in revenue in 2020 due to COVID-19, but impressively bounced back with a new life. Apart from the hurdles brought by the pandemic, the company also faced challenges in 2022 when it withdrew its services in Russia to stand against the annexation and support Ukraine's freedom. In addition to these two sweeping waves, the company remained steadfast when the Federal Reserve Bank imposed aggressive interest rates to curb inflation, leading to a considerable knock-on effect in global exchange rates. During that time, Visa reported a revenue increase of 19% year-over-year when all the other sectors, especially the unicorns, suffered from the sudden hike in interest rates. The company's net income increased 32% over the year, with an exceptional profit margin of 46.6% as of August 2022. This shows that the firm is among those companies that don't report low profitability during economic crisis. Hence, it is highly advisable to invest in this company. The fourth safest company is Alphabet. It is a part of a multinational conglomerate formed in 2015 after the restructuring of Google. Alphabet, trading as Goog, is the parent company of internet giant Google and all its subsidiaries. The firm aims to make knowledge and information available to everyone on this planet. Indeed, a firm with such high thoughts deserves investments. The company's balance sheets and valuation indicate that the firm is all ready to thrive. To your surprise, its recent earnings report has not even included the terms slow or recession that were so common during the period of economic crisis across the globe. Although the share of Alphabet is presently down at around 41% from its highest point. But it's said that this has more to do with a broader market sentiment than the company itself and has led to the internet giant's lowest valuation in 10 years. Surprisingly, the firm has continuously increased its cash flow, revenue, and profits even after all this. The firm officially made the announcement to purchase back its share worth $70 billion earlier this year. An increase will follow this in the intrinsic value of every share. Considering Alphabet's contemporary performance rate, it can easily earn back the money it'll be going to spend on purchasing back the shares in as little as 5 quarters. Can you now imagine the pace of this company's growth? This speed of growth makes Alphabet one of the top companies to invest in. The company holds a 30% operating margin, and its reported revenue growth is 23% year-over-year in the last quarter or as of August 2022. The firm went public almost 20 years ago, and despite this, it looks like the company's time at the top is just about to start. We have reached the middle of the list. ASML Holdings, a semiconductor equipment manufacturer, has held up better than many other technology companies in these turbulent times. While it certainly hasn't been immune to the effects of the COVID-19 pandemic, it held its own. Now, many investors are contemplating how well the company will handle the current economic crisis and the threat of recession and inflation. In the market for the semiconductor industry, it controls around 90% of the lithology systems. Some of its close and biggest customers include Intel, Taiwan Semiconductor Manufacturing, and Samsung. The firm has developed the latest EUV or extreme ultraviolet lithology machines and took the last 2 decades to bring this discovery before the world. These chips are the world's smallest and most advanced chips. With each passing day, the company is proving to be a dominant player in supplying the components for the world's semiconductor manufacturers in the long term. It has a monopoly on EUV technology lithography machines in the market. It is just needed to continue to make smaller, efficient chips. The semiconductor demand is growing day by day because of the expanding demand for laptops and mobile phones, especially after the pandemic. In 2021, only the semiconductor market grew by 26.3%, which is why the company was able to generate 9 billion euros of sales in the first 6 months of 2022. Can you believe it? The story doesn't end here. The firm is expected to end the year with a 10% growth in revenue over the 2021 total revenue of 18.6 billion euros. The company's current backlog confirms that the strong revenue growth is likely to continue, and this further confirms that investing in this company is safe and beneficial in monetary terms. On number 2, we have the world's largest online selling platform. Yes, you guessed right, it is Amazon. The result posted that Amazon has performed better than expected in its second quarter earnings release. Its stock prices have jumped 14% since the latest numbers were announced as of August 2022. Amazon's Q1 2022 results were poorer than the e-commerce platform had hoped for. Q2 fared better and gave Wall Street a pleasant surprise. Q2 revenue set at $121 million, surpassing all previous guidance and expectations. Apart from this recovery, the giant e-commerce platform also posted an operating income of $3.3 billion, beating the expectation by over 10%. Amazon can never be considered a cheap stock considering it is the world's leading player in the cloud services market. The company's infrastructure as a service model involves sharing costs and technologies, means the company can ramp up or ramp down its services and capacity, rapidly increasing business efficiency. It gives an added advantage to the company over the rest of the competitors present in the market. Cloud technology is the world's future. Over 85% of organizations will choose it by 2025. Hence, the iron is hot, so it's now time to strike. Go and buy its stocks. You never know, in the future, its shares may touch the skies or even go beyond the skies. Amazon is trading at a double rate, and this is the lowest it has traded since 2016. Mind you, this 2.2 times forward sales are after the significant discount given by the company compared to its other cloud-dominant competitors like Microsoft and Alphabet. But since the company is labor-intensive, a huge chunk of profit goes to the higher wages given to the employees. But still, the market is not going to shrink, so go on, go shopping for the shares this time. Old is gold, and so are oil firms' shares. ExxonMobil, an oil giant, saw a share rise of 4.3% after the release of the Q2 reports. The report was a mixture of both profit and loss. It shows sales lower than expected and profits exceeding the predictions. As per the analysts, investors can earn $3.74 per share, but the company far exceeded this by earning $4.14 per share instead. The resource found deep into the earth can touch record-high prices. This irony is, coupled with the ramped-up production and cost controls techniques, helped the firm to achieve their most profitable quarter ever. The company's earnings grew more than 280% year-on-year. It has also increased its annual dividend to $15 billion. It built up an exceptional cash flow and reinvested its money in its refinery business. Indeed, higher oil prices are favorable for ExxonMobil. Hence, it doesn't have as much downside from lower oil prices as some of the upstream oil companies due to its comprehensive refining and chemicals businesses. A pullback reduced shares by 20% off in July. This is the perfect entry point for investors to invest in this company. There's no need to worry about stability. The firm has accounted for a 40% gain over the previous 12 months. Investment in the share market is risky, but once you get the trick, you will surely enjoy it. And to understand that, all you need to do is to watch our videos and keep yourself updated with market trends. Watch the following video for such informative topics.